We have Christian Garrett in the Temple of Technology. Welcome to the show, Christian.
There he is.
How you
Good to
doing?
see you guys. I'm good. I'm good. How's it going, John?
It's great.
Good.
I'm
It's
happy.
uh, it's a beautiful day. Where are you calling him from?
I'm in San Francisco, so I'm holding it down. And depending who you ask, this is the future or this is Detroit. So I'm enjoying finding out what's going to happen.
Have you
What's
checked your Signal group chats for mainstream media reporters yet?
Yeah, no, man,
You
I really
clean?
need to step my Signal group chat game up. I can tell you that
Yeah.
much.
Yeah. Just take a pass at the member list. If you see Taylor Lorenz in there, maybe create a new chat. You don't need to kick her out, but start a new one at
Yeah,
least. Move
yeah.
the important conversations elsewhere. Well, thank you for joining. Can you give a little bit of an overview of who you are, what you do, just for the folks on the show who might not be familiar, and then we'll go into to some questions.
Yeah. I'm a partner at 137 Ventures. We're a growth stage venture capital firm. And we want to invest in what we believe are generational category defining companies that can be long compounders and have defensible, sustainable competitive advantages. Like every firm, we have a differentiated strategy. A lot of what we focus on is as a liquidity partner to companies.
Mm-hmm.
We do growth capital. We do invest in primary rounds. But we saw, a long time ago, really on the heels of Facebook, and after spinning out a founders fund, we saw the opportunity to partner with companies on the liquidity side as a way to invest in them and build positions in them. And that's what we've been doing for a while now. And that was a contrarian bet that companies are going to stay private longer and there would be growing demand for liquidity. Now it's somewhat consensus and popular and understood.
Yeah, I think Peter was basically banging the table saying, never go public. And now you have Elon kind of saying the same thing. Hey, Tesla's kind of rough go. Obviously did very well, but got kind of, beat up in the courts and whatnot. And so it's great to see that it's at least an option for those founder-led companies to stay private longer. And we
Yep.
thank you for your service to the capital markets. It's fantastic. You got a question, Jordy?
Yeah, I'm curious. There's been a meme for a very long time that, oh yeah, I'm an early investor in SpaceX, but like maybe there's like a bunch of SPVs separating you and like the actual certificate, right?
Yeah.
They certainly don't have the certificate. How do you think the average investor has done that's like investing into these sort of like, which is not what you guys are doing, but when these sort of power law companies end up just crushing and growing tremendously, does it matter that you're stacked in layers and layers of fees?
Yeah.
Do you get smoked? Can you come out alive? What's been
Yeah.
right?
Well, let me, I'll take a step back too and kind of make a broader point. I will say it's funny you picked SpaceX. I do have a rocket engine right beside
Oh,
me.
There we
nice.
go.
That's
So
great.
yes, we do have a SpaceX rocket engine here in the office.
That's
Um,
fantastic.
Amazing.
well, like I said, let's take a step back. I'd say for the last 2 decades, companies have trended towards staying private longer and longer, like we just talked about. And in order to do that, companies need growth capital and they also need liquidity capital. And the secondary market is just a tool for private tech companies that works just like the public markets in that it just provides liquidity to existing shareholders. There are two distinct segments of that market, which is what you're hitting at. One segment's done in partnership with companies, which is where we at 137 Ventures focus on. And another segment operates outside of that. You don't want to operate outside of that. We've been longtime angel investors, and they have tweeted a ton about fake allocations in their primary rounds being marketed to investors, right?
Mhm.
And so, I will say what you're hitting on is mainly just really just a proxy for demand. And so, investors want to invest in great companies regardless of how. And as demand grows, investors look for supply, and there's only so much supply for primary, which I can talk a little bit about why that is. And secondary is another way to access a company's equity. And so people will do things, to your point, on investing in various SPVs or whatever it is as a way to access. And I think some of that is good and blessed by the company as just another vehicle or avenue to put capital in these businesses. And then a lot of that operates outside of that and is kind of a black hole and maybe not the best place to be in because you, one, don't collaborate with the company, and then two, you
Mhm.
don't have access to information, right? And so,
Yeah.
and the third is potentially, like Andrew was tweeting about, is there could be fraud as well.
Sure. Can you talk a little bit about why, like, how companies think about doing these tender offers, when they do them, when's the right time, and how do they go over, like, culturally? Obviously, there's some incentive and employee, like, just like reward the employees, but what other considerations go into a successful tender?
Yeah. So, the tenders and just the broader market we're talking about has grown dramatically over the years. And one of the interesting things is like a lot of these companies have made the transition to being cash flow positive in the private markets, which means that more shares are actually bought in secondary than primary through things like tenders, right, over the life cycle of the business. Databricks just did that massive round, right, to convert and pay the tax bill for a lot of the RSUs. SpaceX has raised $10 billion in primary over its 23 years of being around as a company. They've been running two tenders annually that total like more than $1.5 billion a year for a long time. And so I think a lot of companies are following in SpaceX's footsteps particularly and building liquidity programs like theirs. Stripe, mentioned Databricks, Applied Intuition, OpenAI, Anduril, a lot of them. What hasn't changed is that it matters who your investors are. So great investors, like they may not make your business, but terrible investors will definitely ruin it. This is why the best companies want to control their cap table as always, and work with investors like us on implementing their liquidity strategy as they scale. And more companies as they stay private longer, as they've scaled, even as they hit cash flow positive, tenders have been a way for them to offer liquidity and kind of postpone going public. And it's a way to align incentives. It's a way for recruiting and retention, like you mentioned, right? If you're recruiting against publicly traded companies, if you're recruiting, software engineers against, Google and Meta, or you're recruiting researchers from NVIDIA or Google, you want to be able to offer not just a compelling package and upside, but being able to offer liquidity also helps bake into folks' kind of comp decisions. You have people that have, structurally have to run these tenders based on their RSUs. Sure. Like X, is on the single trigger RSUs. And so they structurally have to run them for their employees' tax bills. There's a bunch of reasons. Some people also use them to mark the business up, right? If you're not raising primary because you're cash flow positive for years, then liquidity checks a bunch of other boxes, but also allows you to continually show progress in the stock of the business. So I just think, as the capital markets have grown, as these companies have grown, the secondary market has obviously grown with it. And I think a lot of the best companies have had the privilege of working with their investors, working with folks like us, people they want on their cap table and to grow on their cap table to run these programs and control and manage liquidity in a way that's beneficial for the company.
Have you guys looked at any businesses that are basically building like actual, like basically software to manage these liquidity programs? And did you guys ever think about incubating something there, or is every company unique enough that it should just be done by the investors and the company's counsel and it's just all bespoke?
Yeah, I mean, there's like two versions of that. There's the software to run these programs, which exists, right? Carta has great software, right, for running this. And so I think, that's just back to like broader cap table software management trend, which is awesome. Yeah. But that's like more of the execution side. The other side is more of creating a market, right? Yeah. And then using software to facilitate more liquidity and grow liquidity. And that is basically another version of the same thing we talked about earlier, right? Which is like the best companies want to control their cap table. The best companies have unlimited demand, right? And so in that essence, you don't need a broader market to have random buyers and sellers to do price discovery, right? And so I think the best companies generally like to run their own processes and work with their major shareholders, and a lot of times, which includes us and a lot of these companies as well, on kind of running these processes, very similar to how a primary process would run, just a different type of transaction and goal.
Yeah, to me, it feels like you guys are in the financial services business in many ways when you're creating these sort of programs, and you're an investor as well. And there's constantly people that see the opportunity, they see how big it is, they try to attack it with sort of software and marketplaces, and then time and time again, I feel like we see them sort of flop. And you saw this with Carta, basically kind of apparently giving up on their entire secondary brokerage business at some point. But again, people in venture always see a problem and an opportunity and want to like throw software at it. And sometimes it's basically, companies like Anduril saying, yeah, we want to work with 137 Ventures because they've done an exceptional job, with their relationship with SpaceX. And, we want that kind of partner as well. And that just looks more like traditional financial services versus, a venture business. Do you give any attention to every once a month, these sort of list pops up around different companies, and sometimes I see this list.
Well, they're doing your job for you, because you see a list on Twitter, you can just go hit the company up, right? You can just, you don't even work
and
that.
Usually you see 10 companies and you're like, all those make sense. One of them,
Except for that
except for that one. So do you give any weight to these lists, or is it just random?
Where do they actually come from? Because it doesn't
Yeah.
seem like it's put out by 137 Ventures, which I would
Like,
trust.
to me, it could be a single broker who's just basically pumping their own bags. But
Yeah,
I don't give a lot
you guys nailed it. Yeah, I mean, I mean, look, it depends where these lists come from. A lot of them are noise. They're not signal, of transactions, and a lot of those transactions are uninformed buyers and uninformed sellers.
Yeah.
As an institutional firm, we don't pay attention to them, and the best companies don't either. It would be amazing if the job was so simple as to look at a list and press a button and buy. But unfortunately, there's a lot more to investing than that. I think you'll see them either like aggregating a bunch of transactions from a platform level, but still a brokerage business, or you'll kind of have brokers who are, sort of trying to create a market and advertise what they may or may not have access to. That is in that segment of the market that I think the best companies don't particularly like, and that you don't want to be in as an investor on the secondary side that we talked about earlier.
Yeah, can you talk a little bit about like how do secondary shares work their way into the broker system, and how transfer restrictions work a little bit, and how those have evolved over time?
Yeah. So on the first part, I mean, it's a broad range, right? I mean, this is you have employees that may not be under transfer restrictions.
Mm-hmm.
You'll have a lot of employees that may do transactions on a forward basis. So they're actually violating transfer restrictions, but it's through a different type of construct.
Sure.
You have a lot of this too are just SPVs, right? So as investors, a lot of institutional firms will do co-investment vehicles with their LPs. And then those LPs will want liquidity. And so, you in essence have liquidity into the SPV, which then allows you access to the underlying company. So there's just various forms of supply. As companies grow, right, there is a lot of avenues where there just is supply. And some of it is legitimate, some of it's not, but it definitely is. There's a lot of legitimate supply for sure, right, from employees or SPVs, et cetera. The transfer restriction side actually hits on like this whole dynamic, right? And this actually all goes back to the Facebook days. So in the 90s and early 2000s, companies only had a right of first refusal, and that was sufficient to discourage random buyers. Facebook was obviously a popular consumer business and the first to go to tens of billions of dollars enterprise value in the private markets, and there wasn't as much money in venture back then. So the company lost control of its cap table because the volume of shares that traded was well beyond what the company or existing investors could purchase. And so you basically just had a lot of outsiders being able to buy, right? Because there's a ton of demand. The existing investors, weren't able to just use a ROFR as a way to buy it and control it. And so once other venture companies saw this, they implemented basically blanket transfer restrictions. And that has been the default ever since. And so you have to understand, like, the entire benefit of being private is that companies can choose who they give information to and allow the cap table. No founder wants an activist investor. And if you control your cap table, it's kind of no longer your choice. And so transfer restrictions have sort of been the default.
Or even in the case of Facebook, like Yahoo could have potentially like built a position, or Google could have built a position in the secondary market, and then had rights at some point, which would be potentially disastrous. Didn't happen, but that's the risk. So if there are no transfer restrictions, does that mean like an early employee could just meet a random VC at the Rosewood and say, "Oh yeah, I'm sitting on $2 million of stock in this company. You want to take it off my hands?" And they can just do that over a handshake and some contracts, or does it eventually need to bubble up to like the company? How does the company actually know who their shareholders
are? There's still a ROFR, right?
Okay.
So yeah, and like I said before, with the right of first refusal, it was enough to discourage this. But then with Facebook, the demand overwhelmed the ability for the investors to actually exercise that right. From a capital perspective. And so
and the ROFR is just the ROFR is discouraging, because if I'm trying to build a position in a company through the secondary markets, there's no transfer restrictions. I know that. I go to an employee, I say, "Hey, you have $2 million. I'm going to keep running into this problem where we get a handshake deal. I'm going to buy $2 million, and then the company buys it. And then I go to the next employee, right? And it's just a waste of my time." That's the main structure of
it's the company
ROFR?
or the other
or
investors.
The other investors.
The investors. Correct.
Yeah,
Exactly.
Talk about the companies you invest in, or many of them you described as having like effectively unlimited demand for the equity. And right now we see venture funds that have ballooned and they have more capital than ever to deploy. It used to be these companies would get to the point where the VCs would be like, "I remain giga long your company. I just like I'm fully tapped. Like I just got to let it ride.
Yeah.
Now it's less the case with
Sequoia
some of these
Fund
multi-stage.
3 with like 30 mil. And
Have
they
you
were
seen?
happy.
Do elbows get sharper in some of these later rounds? Where I imagine from an AUM standpoint, like you guys have a ton of AUM, but you're coming to the table with people that might have 10 times as much AUM and these capital bases where they can hit up a sovereign and be like, hey, we're doing an SPV into this one. Do you want to come in?
5 billion.
Yeah.
Yeah.
So what's the competitive dynamic in these sort of later stage
Good
rounds?
question. I think it's a bit, I'd say like to your point, 100% as these companies really scale, and demand obviously follows suit with the performance of the fundamentals of the business, and how they've executed on the story. You do see obviously a ton of, I mean, if SpaceX does a tender and they're 10x oversubscribed, right? That is, billions and billions of dollars of demand, right? That is unmet. And the investors, to your point, the venture ecosystem has grown, so there's a ton more dry powder in the market as well. But also, I think the size of these tenders and primary rounds does scale a bit, definitely on the tender side. So I do think like as a company grows, its secondary market does grow, and the liquidity programs grow in size, so that helps meet some of the demand. But you 100% run into that. Like, look, at I think a certain stage it works, but there's a certain stage where like there's more demand for SpaceX or Anduril than there is supply, and that just is the function of it. And I think that's where relationships really matter. But even then, right, there's still a limit, right? So I would say like I think relationships end up being the biggest driver there for your ability to still not just obviously an allocation, but also try to continue to size up the position and invest more. I think being a major shareholder, being around for a long time, and having very close relationships, which is what we focus on, gives you
it's a likability. It's a likability. Allocation and venture is like often comes down to likability. It's like, does the CEO and the management team like you? If so, cool, we're going to give you preference.
What's
if
that quote?
Not,
It's like,
you might get your pro rata. Otherwise, good luck.
Being an SPV promoter is more like being a club promoter than being like a VC or something like that.
I have a more
ventures, venture is unique. Venture is unique because it's a unique asset class given how important access is. Mm-hmm. And access and that dynamic there leads to like you could be you could end up getting access to an incredible company, and maybe even still be a schmuck, to your point. However, doing that consistently and over a long time frame, I think is a different story.
Yeah, totally. How do you advise founders that are kind of reaching the territory where you guys are starting to invest? I'm going to pull out a number. Let's say they're close to 9 figures of ARR. They're a real business now. It's working. They're raising a bigger round that's some mix of liquidity for the team as well as some growth capital. And they're worried about kind of like signaling risk around selling secondary, right? In the public markets, you see this. It's like, okay, this CFO is like selling a huge amount of their position. That's obviously bad. Same thing on the founder side. If the founders are selling huge amounts of secondary, it can be a bear signal. And we saw the worst of this in 2021 and 2022, where founders would be selling like $50 million, like pre-product market fit. And that wasn't common. But how do you advise founders as they start to get opportunities to get liquidity and they're sort of worried around, well, I'd like to be able to like buy a house and put my kids through college, but without stressing about it, but I don't want to send the wrong message?
Yeah, I mean, I think you hit on the reality of obviously they're the obvious extremes, right? Which is if a founder is selling 90% of his position while still operating the business, that's obviously gonna raise eyebrows and people are gonna protest that. And the founder sells $10, also people probably aren't gonna bat an eye, right? So what number in between is the magic number depending on stage? And look, I think one, it's usually driven by life needs. Right. And so that de facto backs into a dollar number that makes sense. Right. And so I think in many times the conversation is around de-risking, around a life need. Someone just had a kid, they're starting a family, they want to buy a house. Right. And so I would say like, you're also investing in founders that you trust and are rational and reasonable. And usually these conversations are fairly easy from that perspective. I don't think there's like a particular dollar amount. I think one of the things to think about, whether you're a founder or, on the investor side, is more so like you want to think about the two dynamics around percentage of holdings and then total dollar size, right? And those are interesting, right? Like in some sense, if you sold 5 million bucks, but it's half of your holdings, right? 5 million bucks at a certain stage of business is not a lot, but selling 50% of your position while still operating, may signal something. And it works both ways, right? You may be able to sell $100 million, which is a lot, but it could be, 5% of your position, right?
Yeah.
Which generally people would not view as a lot. And that's the conversation. So I think it's a bit of like, it depends on the circumstances and the context, but for the most part, founders are pretty rational and reasonable. And you got to remember, most founders are the most bullish in their company, even more so than the investors. So the desire to sell is generally pretty tapered and usually driven by life needs.
Makes sense. Well, thanks for stopping by.
Great to have you on.
Great conversation.
Can we see the rocket again? Can we see?
Show us the rocket
again?
one last time.
Let's see the rocket,
and then we'll get on to the next
there
one.
We go.
Oh, that's a beautiful engine. Let's hear it for the rocket, folks.
Yeah. If you end up with a spare rocket, we'll throw one on the
send
set.
it over if you got an extra one laying around.
I need at least 3 more appearances on the pod.
Okay. Deal.
I can talk to the rest of my partners, and maybe 137 Ventures will send you a rocket. We'll see.
Fantastic. You heard it here first, folks.
It's great having you on.
Have a great rest of your day.
We'll
talk to you soon.